Major markets managing another day of gains, even as data on housing and manufacturing came in weaker than expected. The S&P up 0.4%, the Dow rising for a fourth straight day, closing above its 200-day moving average for the first time since April. The Nasdaq posting its highest close in nearly 4 months. But with a slew of retailers reporting this week, as well as more data on the housing market, can this momentum continue? Tim Seymour, fresh back from vacation. You've been away for a week. You've gained some perspective.
I'm not sure. Well,
what do you think of where we are right now?
Y'all rallied this thing pretty hard, and I think the tailwinds from disinflation. So off that CPI, I was, had a kilt on and bagpipes in my hand in Scotland. No, I didn't. I just told you I didn't. But when I looked into that CPI number, clearly the deflationary tailwind from that dynamic, I think what you're getting also in terms of finished goods prices, and the market feels that this is coupled with, on a day like today when you got really not like a terrible New York number, a not great housing survey, and then China cuts because their economy really needs to do some major boosting. This is a dynamic that actually the equity markets have enjoyed, and we've all done this math. I mean, 18.25% on the S&P off those intraday lows. Semis are up 29.5% in 29 sessions from July 5th. So this is a dynamic that I think doesn't really weave in EPS dynamics from what was a pretty good second quarter. But again, I think less Fed and the CPI dynamics are what, from afar, is what this market did. And I'll just say this is a market, though, that behaves as if the Fed put is in play. This is a market that's behaving like the market we knew last year. And that's what's interesting to me, because the positioning for the investor base, I think, for the last 6 to 9 months is maybe as much to do with the market's rally as anything.
Yeah, I mean, Mike Wilson's out with a note today saying basically that where we are right now is very different because from an interest rate, from a policy, from an earnings perspective, we are in a very, very different place. And yet here we are sitting at these levels, Dan, and we're about to get a more real-time read on the U.S. consumer than that CPI print that we rallied off of last week.
Listen, I'll just say this. I mean, we've all been doing this a long time. This is not that surprising. If you think that the S&P was going to maybe correct and it was going to go somewhere in the mid-3000s and it almost gets there, and then you say, oh, well, it could get back up to 4,200, it's going to overshoot. I mean, that's the way this stuff does, and it doesn't line up with the data precisely. And Tim just mentioned Q2 earnings, and I think when you focus on those major names, the huge components of the S&P 500 and the NASDAQ, they were clearly better than a lot of people had feared. But then when you broaden it out, okay, and then you take out energy, there was not a lot of great stuff. There was not a lot of really good visibility. And then now you piece it together with some of this data that we're seeing. And Tim used the term disinflation. So we're seeing, inflation.
That's a tailwind.
Yeah. So fine. But no one's saying mission accomplished yet. No one's going to put their faith that the Fed nailed the landing because there's a lot more that has to happen. I think what's different also, if you think back to 2008 coming out of the financial crisis, I mean, China and what they were going to do as far as spending was really a huge tailwind. If you think about it, we don't have that right now. We don't have Europe. We have, it's not just this housing data that's rolling over now. We also have a scenario where small business CEO confidence is really low. So again, don't be fooled by what the stock market has done in the summer after a sustained downturn like we had. I guess I'd focus a little bit more on what the 10-year U.S. Treasury yield is doing or not doing, because at 278, it's really suggesting that we're going to be well below the sort of growth that people would expect with an S&P 500 that's raging. So to me, I think I'm a little bit more bearish on the stock market than I am on the economy. I just think that the market has shot too far too fast.
Guy?
I agree with Dan on this one. I'll say I think what the market is trying to do is say, hey, Federal Reserve, we see the data coming out and it's miserable. Obviously, today's data was miserable, and we don't think you can continue this rate hike cycle in the wake of or in the face of what's been really poor data. And we're just going to keep pushing the envelope here on the buy side in equities, which I sort of get. By the way, on the flip side of that, they've trotted out all kinds of people from the Fed to suggest quite the opposite, that, you know what, inflation's still our main concern, and we're going to do everything we can to combat it. And they're the battle lines. But I think the Fed will win out on this one in terms of having to continue this rate hike cycle, and I don't think the market's going to like it. And, oh, by the way, which I love to say, we haven't even started QT yet, and that starts in September. So let's see how the market reacts to that. So I think this look, I thought it would stop at 4,200. We're at 4,300 now, but I think it's too much too fast, and I think it's discounting everything the Fed's trying to do.
Jeff Mills, are you going to round out the caution on the panel tonight about the markets?
Yeah, I guess so. And we're all saying it in different ways, but I think the bottom line is that the catalyst for this latest market move is this Fed pivot. It is interest rates going from 350 to where we are today. It is this peak inflation narrative. And look, I've been fairly bearish and negative for a number of months now. And I'll say this: the inflation peaking narrative, the slowing, that's clearly a positive, right? I think it reduces the fears of some sort of 1970s type issue. It reduces the fears of a super aggressive Fed, maybe the severity of a GDP contraction, which I think we do get. But what the Fed needs to see is a sustained drop in inflation. They need to be convinced of that, and they're going to keep hiking until that happens. And I just don't think they're going to see what they need to see until they hike us into probably a recession, or at the very least, a very noticeable and impactful S&P 500 earnings slowdown. We've gone from 252 now to 243 for 2023 earnings. So ultimately, that's going to impact valuations. I don't think that, given the fact that the Fed's tightening, growth is slowing, unemployment claims are moving in the wrong direction, I don't know how high of a multiple this market can carry. So again, that's still what leaves me with a fair bit of caution here.